So I was browsing Facebook the other day and I came across this ad from a magazine. After the pandemic, will inflation return? And it got me thinking, why wouldn't there be inflation? I mean, after all, the government's printing a ton of money, which would put the increase in the money supply, and if there are more dollars out there, currency would just get diluted, right? Well, it turns out that the article says that inflation is dead. Because of unemployment, because of the contraction in our economic output, people are saying that we might go the way of Japan, which you may know has been in a nasty deflationary period since the 90s. They're saying that central banks are not tightening monetary policy because there is no inflation, but many economists are saying that there appears to be no inflation because the indexes, such as the Consumer Price Index, doesn't accurately capture asset prices. And as you know, the CPI is probably the most widely used metric for calculating inflation. So if you look at the 700 items in the basket of goods in the Consumer Price Index, the largest proportion of it is shelter, which approximately at 25 to 30%. And just thinking about it, that's probably where the banks get their TDS and GDS ratios from, of what they think you can borrow. Anyway, the shelter portion is comprised of rent and mortgage costs, insurance, repairs and maintenance, taxes, and utilities. Rent and mortgage costs are by far the biggest proportion of this category, but because interest rates have hit historic lows, most of you out there have noticed that your payments continue to stay low despite being able to borrow more. So for example, if you had a $1 million mortgage at a 2.99% interest rate, you'd be paying about $4,700 per month on principal and interest payments on a 25-year amortization. I mean, I was stupid and locked in around this rate, but before the pandemic, and I didn't know interest rates were going to drop so much. But anyway, as you can see, interest rates are about half of this right now at 1.49%, which makes the payments drop by over $700, which is about 15% of the mortgage lower. That's a huge amount over the term of the mortgage. In fact, at a $1 million mortgage with the lowered interest rates in this example, with the same payments at a higher interest rate, I could have got myself another $184,000 in borrowing power for the same amount that I'm paying now per month. So they also use rent prices to calculate that portion of CPI. Well, we all know that cap rates are getting some pressure to compress, meaning that either the rent that you would get for the purchase price of the asset is lower, or that the asset price is steadily increasing. It also doesn't help that rent prices have come down in the city, about 20% in the Toronto market, and maybe more in some major cities around the world. So technically, with lowered interest rates and the current state of rental rates, it allows more room in the CPI index for asset prices to inflate. So you might ask, why doesn't the government account for asset price and inflation? I mean, because how would an economist track what assets a person should hold in their portfolio? That could range from anything from real estate to stocks and bonds to vintage cars, fine art, hell, wine, I don't know, hockey cards. How would you value all of that? As I read more into this, there's a recent interview by RBC's chief economist. He says that the central bank chair does indeed pay attention to asset price inflation and that it always matters, even though there's no formal index to track it. They closely monitor any imbalances that develop in asset markets. Asset price inflation is an indication of imbalances building that could pose a risk to the economy. So they could technically wipe away the imbalance in asset prices by simply increasing the interest rates, but there's a whole school of thought that says the government can't do this. With an aging population and healthcare requirements, all the stimulus packages that were created from this pandemic, someone is going to have to pay for it all, and that's future generations. The only way to do this is by printing more money. Interest rates simply cannot go up. Too much of the economy would fail. Businesses will shut down, people wouldn't make their mortgage payments, and it would be more expensive for the government to borrow more money, which would just increase the deficit even more. In fact, the Bank of Canada has publicly stated that interest rates are going to stay low until we can maintain a 2% inflation target, which will happen well into at least 2023. So I think we're going to see a huge boom in asset prices, particularly as Canada has stated that we are going to recover from a pandemic through immigration. We're going to increase the immigration targets to over 400,000 over the next 3 years. And we've seen previous targets around 300,000 in 2018. And you probably saw what that did to our supply and demand ratios in the urban housing markets. So what's going to happen post-pandemic? The government is in such a tough spot. Too many sectors of the economy need help that they can't do anything but keep interest rates low and continue to pump more money to the monetary base to boost consumer spending and borrowing. Combine that with the increasing demand of housing through drastically boosted immigration targets, and my opinion is that we're definitely going to see a boom in housing prices over the next few years after we recover from the pandemic. So how do you take advantage of this? I mean, I would say just put your cash and your equity to work. Go buy more real estate, go put it in the stock market. I don't care. It doesn't have to be real estate, but just don't hold on to your cash. And if you have any questions, as always, you can give us a shout. So go to www.broadviewavenue.ca, click on book an appointment. It's very easy, and you'll get one of us on the phone or even Zoom, and we'll go from there. So until then, Happy New Year, everyone.